All right, you can see a screen now?
Yep.
Okay. So non-compliant purchases. Investigate and or verify fraudulent or non-compliant employee purchases. So this is a new module they added when they redid this thing. Definition of fraud. So it's a false representation of a matter of fact, whether by words or by conduct, by false or misleading allegations, or by concealment of what should have been disclosed. That's kind of like a run-on sentence covering everything. That deceives and is intended to deceive another so that the individual will act upon it to his or her legal injury. So for it to be fraud, you have to have legal injury and you have to have a deception. So it's got to be, fraud must be proved by showing that the defendant's actions involve 5 separate elements: a false statement of material fact, knowledge on the part of the defendant that the statement is untrue, intent on the part of the defendant to deceive the alleged victim, justifiable reliance by the alleged victim on the statement, and injury to the alleged victim as a result. So if there's no injury, there's no fraud.
Interesting.
Yeah, but you know, that goes to say, well, what is injury? Is mental anguish injury? Could be.
I know, but if it's like if no one catches the fraud, this is saying that fraud never existed.
Well, or the guy only gets halfway through the scheme, the fraud really exists. He meant to deceive, but he just wasn't successful. So sources of fraud. Estimates are that most organizations lose 5% of their revenues to fraud. Most of it is due to corruption and billing schemes. Some of the sources are procurement planning. Employees can split supply management requirements to avoid higher dollar thresholds. Yeah, that's gone on around here a time or two. I wouldn't call it fraud, but solicitation of RFP planning. So employees can plan a solicitation that does not include competitive bidding or even make arguments for sole source event. And this assumes that they're getting some kind of kickback from the supplier. Solicitation phase, employees can exclude qualified bidders, again, because of kickbacks from suppliers. And source selection, same deal. They can reveal or leak proprietary or confidential information during the bidding process. Contract administration, employees can make unauthorized material changes. So approve engineering change requests would have made the supplier less competitive. And contract closeout can alter, backdate, and modify contracts documents to cover up procurement anomalies. Some of the ways that can happen. So fraud happens with the fraud triangle. So 3 things that need to happen for a fraud. You need to have a financial need, pressure, or some kind of incentive. The person committing the fraud has to have some kind of rationalization as to why they are entitled to it. And then there has to be an opportunity. The person committing fraud has to perceive that there's an opportunity to get away with it. So those 3 things create the fraud triangle. So it's a theory that tries to explain why employees commit fraud. So in the right conditions, if the conditions are in place, employees are likely to commit fraud. Maybe, maybe not. Depends on how you were brought up too.
Isn't that, so, what was it, the X theory versus the Y theory? You're always,
yeah, yes.
People are bad versus people are good.
That's management looking down at us. It's like if X theory is management says these guys are all lazy and fraudulent anyway. Y theory says they're good people.
Yep.
So if the right conditions exist, perceived financial need, you know, that's a common motivator. Financial debt, gambling, drugs. Other motivations are greater job recognition, job dissatisfaction, feeling underpaid. All of those are financial motivators. Need can be controlled by eliminating unrealistic targets and expectations. And perceived opportunity. Is the opportunity present, and does the perpetrator believe that the crime will not be detected? For example, if the person committing the fraud understands the controls well or a lack of controls, then they can determine whether they get caught or not. Perceived opportunities can be controlled by procedures, reviews, and audits. And in all of this stuff, you'll notice that a lot of it happens in small to medium-sized firms because they don't split up the duties like we do here at PACCAR and other large firms. Rationalization, employees may convince themselves that it's only fair to behave in such a way. And for example, the amount is so small that it will not affect the organization or no one will notice. Other rationalizations, the rationalizing in their mind, the situation is temporary and the fraud is one time and will never happen again. Of course, they keep doing it, and the individual rationalization can be controlled by developing a strong code of ethics. And then we got to go into types. Employees responsible for purchasing a product or service collude with the supplier to purchase a product at a higher cost, cheaper product that doesn't meet the standards, or this is the most common example. This is the most common example of procurement fraud is they're working with the supplier in collusion. Fraudulent companies set up by the employees. This is less common, but it still happens. Few employees may collude to form a fraudulent company and keep on issuing payment in the name of that company. So I don't know that this could really happen with goods because you'd have to deliver something, but could happen with services. Payments are generally small enough that it doesn't raise any alarm. There are multiple reasons this could happen. Company doesn't match invoices against purchase orders before payment. And we do this, but only with our very large suppliers and shipping goods. I think what we call the evaluator receipt settlement. They don't invoice; they just pay off of the receipt and the PO. One individual manages the entire process from purchase to payment, so that's a big no-no, and there's a reason for that because it's just too tempting. It's not really a problem here at PACCAR, smaller businesses. Conflict of interest. The individual responsible for purchasing selects a supplier is related to him or her in some fashion. Uncle, brother-in-law. The individual responsible for purchasing selects a supplier in whom they have an ownership interest. Now, this could happen, and it can be difficult to detect too. So this is from 2016. Somebody did a survey. 68% of the fraud occurred on quotes, invitation for quotes. 50% in the payment process. A lot of it has to do with, quoting and vendors, some payment. Indicators of fraud. Common indicators. Indifference, this would be the commodity manager, really. Indifference towards poor quality goods or services. Unchallenged price increases. Not willing to replace a supplier if the supplier exhibits poor performance. Sole supplier communication, when the buyer resists allowing anyone else to communicate with the supplier. I would kind of read that different, but that's what they mean is the buyer's the only one talking to the supplier. Feedback from other employees, unnecessary broker, middleman required by the buyer. Here's some schemes. Something called bid rigging. Supplier and buyer conclude on things like inflated pricing. If you got no competition on the bid, it's even better. Phantom supplier and fictitious invoicing. Fake invoices are posted and paid by employees to phantom companies. Leaking of bid information involves employees' disclosure of proprietary or confidential information about one supplier to another, usually on cost, where you need to be to win the bid. Nepotism or conflicts of interest. Employees have family members or close acquaintances working at the supplier. This, again, is more difficult to detect. Supplier management professional having a vested interest or financial interest in the supplier. It's kind of the same thing. And bribery or kickbacks occurs when gifts of greater than nominal value is given to include paying for trips. Used to be bottles of booze at Christmas all the time, a bunch of stuff like that. Change order abuse. Buyers collude with supplier on a low price up front and then allows unchallenged change orders to increase the price after the business has been awarded. And purchase for personal use or resale. Employees purchasing products or services on the organization's account. This is where you would get into problems with the credit card fraud from the P cards. Rig specifications. Employees develop a product spec that are either too narrow or too broad and favor one particular supplier. Only one supplier can meet the specs. Split purchases. Divide purchases into small POs in order to avoid management review. And unnecessary purchases. Employees make purchases such as unnecessary repair or maintenance or quantities of spare parts that may never be needed. Reporting mechanisms. Employees need to report suspicious behavior, which requires good reporting mechanisms. So critical characteristics of reporting are confidentiality or anonymous reporting. Otherwise, people are probably not going to come forward. And reporting to an independent third party outside of the organization. Meaning outside of procurement, probably. How to prevent procurement fraud. Educating employees and suppliers. What's your bid process? How do you select suppliers? Conflicts of interest. And we do a pretty good job of all of that. Procurement controls, this is the biggest one. All purchase requisitions should be approved by authorized individual. Only invoices that have a pre-authorized purchase order can be paid. Expense reporting system or P-part card system can be used for small dollar amounts, but it has to have good controls on it. And for purchases which are happening through credit cards, a valid receipt and justification are required, which goes to the good controls for the P card. But you got to split the three duties. You know, you got accounts payable, you got purchasing, and you got receiving. And those got to be done by three separate people. Internal audit department. Audit should be randomly selected purchasing transactions on a regular basis to ensure that there's no gaps in the implementation or control. And we do internal audits. Segregation of duties. This is what I was talking about. The same individual doesn't have control over the entire purchasing process. So you shouldn't have one person that can create POs, key in invoices, and issue payments. And this is not a problem in large businesses, but it's a very big problem in small businesses and nonprofits. An ideal case is that there are two different departments handling purchase orders and invoices. Procurement department managing purchase orders and accounts payable managing the invoice capture and issuing payment. And then receiving would report to a materials group or something. Be watchful, things to look for, changes in lifestyle, extravagant personal spending, extravagant purchases posted on social media, automation of control. This helps with fraud. So an electronic system for creating POs and then approving the POs at the right authorization levels. Ability to create a receipt for purchases ensures that there is proof that the item was received against a PO. Without a receipt, you only have a two-way match. So automatically matching a purchase order with a receipt in the system and an invoice, which is the three-way match, shows that you're paying for the same items which were purchased and delivered. So you usually want a three-way match. There are occasions when you do a two-way, but usually that's very high volume goods for like us for tires and stuff like that. Complete visibility into spend. The data is one place and reports can be run to provide historical purchasing information. A lot of large businesses get into problems with this because they buy companies and they don't ever set up the same ERP systems.
All right, what's a three-way match? I'm not.
Okay, so three-way match is you got a receipt, you got a PO, and you got an invoice. And all three of them got a match. Two-way match would just be an invoice and a PO. So here's the fraud scheme matrix. There's a category, different categories. Here's the preventions over here. And then these are procurement process areas over here. Got a little picture for you. All right. What are the three legs of the fraud triangle?
D.
Isolation, sociopathic behavior, and financial need. No, I don't think so.
No, D is in dog.
Oh, D. Yeah, that looks pretty right to me.
I think I remember rationalization being on there.
See what these guys say. D it is. Okay. Jane Jones is a category manager with Acme. She has been assigned to the cross-functional team assigned to produce recommendations to the CFO for how to prevent procurement fraud. What should Jane and her team recommend to the CFO?
A or B? I don't know. They both seem to be about the same.
Yeah, you gotta look carefully. So it's got 1, 2, 3, and this one's got 1, 2, 3, and 4. So I'd probably go with the broader one, B. Let's see what we got here. B it is. One that covers more ground. Right. There's 5 questions out there, so go ahead and get on them and just raise your hand when you get done, and we'll go over answers. Bum, 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 bum.
I'm ready.
All right. We'll get some answers here. E9. All right, number 1 is alpha. What John really needs is information to give back to the general corp as to why they are not winning any sheet metal bids. If Sally refuses the information to either John or general corp, then it may be time to move to option C. 2 is Bravo, because you must enforce a separation of duties for PO creation, receipt, and payment.
Yep.
3 is Charlie.
Yep.
Yes, the situation is a conflict of interest for Joe. However, it could be a good option for Acme. Just have to let everybody know what's going on. 4 is Bravo, because Joanne does not know the full story now, but there are enough behaviors from Luke to suspect fraud. And 5 is also Bravo, because the junior staff member compromised the sourcing process by not treating all the bidders fairly. All right.
Cool. Thanks.
All right, cool. See ya.